Tell me if I'm wrong, but at some point of time, you would have considered investing into a Yes Bank, Suzlon, or maybe a Vodafone Idea. Of course, the presumption is that a turnaround is just around the corner and one can make 3, 5, even 10 times their money. Whether it happens or not is another story, but interestingly, the biggest wealth creators in the stock market are actually turnarounds, and that will be our topic of inquisition in this video. In the simplest of words, a turnaround is a business which didn't do well for a prolonged period of time and has now started showing big and visible signs of improvement. This improvement can be measured in terms of stock price performance, like what we are seeing with the State Bank of India after many years, and also in terms of business parameters, like what happened with Apple after Steve Jobs took over the reins of the company. In fact, turnarounds need not be company specific, and even sectors can go through that cycle. A good example is the chemical sector in India, which went nowhere for 2 decades, but then thanks to growing demand, a drop in prices and capacity expansion, the sector has done exceedingly well in these last 7-8 years. My point is, turnarounds are the ultimate contrarian play, as one needs to bet on a company, sector, or even a country when most others don't believe in it. And while the risk in this approach is above average, it is my belief that with a clear strategy, the rewards can be far superior. My research points out to 5 essential steps an investor will need to employ when identifying, buying, and managing a portfolio of turnaround stocks. And if you enjoy this video, if you find it informative, then do let me know by pressing in the like button. Let's begin. Now, there are a few ways of shortlisting potential turnaround candidates, and the most common approach is to pull out stocks that are trading below a certain percentage from their all-time highs. So while on a screener, this is a simple formula, but at 1,900 entries, this is more of a long list rather than a short list. Further, one has to be careful and not use the lifetime high, as this number might paint an incorrect picture. For example, DLF, which is 58% of its all-time high, which happened in 2008, has been seeing some decent momentum for the last 3 years, which means anchoring our shortlist on a lifetime high that happened 15 years back might not be the best of ideas, and perhaps restricting oneself to a shorter period like the last 3 years all-time high might be a better idea. So when I did this, the list started to shrink considerably, and we are now left with companies that have either lost their shape recently, like the Adani siblings, or we have companies like Vodafone Idea, Indus Towers, and Bandhan Bank, which have not been moving anywhere for some time now. A second way of shortlisting potential turnarounds is by working the profits. Understandably, this is not an easy thing to do because many of these companies would be in losses, and this is where a like-to-like comparison across quarters becomes useful. For example, Jain Irrigation Systems Limited has a good track record in micro irrigation and plastic pipe manufacturing, but due to significant liquidity issues and weak demand, the company had to delay its debt servicing and eventually go for loan restructuring. Consequently, the stock price fell by over 95% even before COVID struck, but the company is slowly but surely finding its feet. And as we can see here, the last 3 quarters, that is June and March of this year and December of 2022, were a lot better than the same quarter and year before. So essentially, there has been an improvement in profitability at the operating and net level. The loan interest rates have been coming down. The operating margins have gone up from 9.1% in FY22 to 12.3% now. The promoters have brought in 130 crores in equity, and while the receivables position continues to be high, there has been some visible improvement in collection and the working capital cycle. The point I want to drive here is that the profit numbers have to be looked at in the same informed manner, but if you're feeling lazy and all you want is a shortcut, then go for method number 3, which is at least 3 quarters of increasing profits after a string of loss-making years. I think the perfect example of this is Zomato, whose quarterly profits have shown an improving trend, and just last quarter the net profits moved into positive territory. However, the big question here is,
but how do I find it?
Well, it's not that difficult, and at least 4 quarters of data is available on most screeners, and a simple query can help us understand the profit trend. A fourth way of shortlisting companies is using their credit rating, and Jain Irrigation is an apt example of a company that has improved from a D rating just a year back and is now at a triple B with most rating agencies. In other words, the rating becomes a proxy, and if you see companies going up the rating ladder, then it typically means some kind of turnaround is happening there. And finally, there are companies who often miss the valuation buzz for some reason or the other. And for this, we don't have to look beyond the State Bank of India, whose share price for an entire decade did absolutely nothing. I mean, one share of SBI was 349 rupees in the year 2010, and in 2020, before COVID happened, the share was priced even lower at 327 rupees. Now, during this period, and mind you, we're talking about India's largest and amongst the world's top 50 banks in terms of assets, and during these 10 years, the bank's profitability had doubled. It had merged with other associate state banks, making it bigger and stronger. It had cleaned up the NPAs, making it a lot more efficient. And these were changes that one could very clearly see, which has now resulted in 150% growth in profits and consequently an all-time high price of around 600 rupees. So these are some techniques investors can put to good use when shortlisting companies. And while you're at it, it's also important to understand what had initially gone wrong and what is the company doing about it, which includes loan restructuring, change in management, infusion of capital, sale of non-core assets, and other stringent but calculative moves. The next step in a turnaround investing strategy is to do with basic financial analysis. And please note the focus here is not on doing a discounted cash flow. Instead, there are two objectives here. Firstly, and yes, we need to have some idea on the future earnings potential. And secondly, and more importantly, one has to determine if the company will actually survive. These are two important questions, and my general observation is that 90% of the times, so 9 out of 10 times, a turnaround will take longer and it will be a lot harder than anticipated despite of any assurances given by the management. So the first thing for us to look out for, and enemy number one for a troubled company, are its debt levels. In fact, it's often a double whammy because A, the company needs to make principal and interest payments to its lenders, and secondly, they have to do this when the cash flows are actually declining. For instance, look at Panacea Biotech, which carried a lot of debt in their books for many years, and the high interest payments ensured that this company did not make a profit for many years. But then sometime last year, they sold their pharma business to Mankind and utilized this cash to get rid of its debt, and the company has been making a profit for the last 4 quarters. So it's a mini turnaround for them, and anyways, the point is a comfortable debt servicing position or reducing debt or zero debt is a great scenario to be in, which definitely improves the company's chances of doing a turnaround. Another variant, and a very logical one, is the cash position of the company. And when identifying turnarounds, this is one crucial number to track, because let's face it, companies get into trouble when there is a shortage of cash, and they also come out of their troubles only when they have sufficient cash in the books. In this regards, generally you'll find that the troubled company has to sell some of its non-core assets, and there are many examples of companies that have done that. This asset retrenchment is actually a positive sign, because not only does it mean the management is thinking about how to set the situation right, but it also helps in reducing the debt and building a cash reserve for the company. Another important metric to look at is the reduction in the company's SGA, which stands for Selling, General and Administrative Expenses, which in simple words means the fixed cost incurred by a business irrespective of the level of production. Now, one of the visible signs of any company that is gearing up for a turnaround is a steep reduction in these expenses. For example, Thermax was going through some tough times about a decade back, and as part of the restructuring, one of the first things they did was to bring down the employee cost from 16% of their turnover to less than 7.5%. This helped in improving margins, also brought in a performance culture, and these are some characteristics that we as investors have to look out for. The final part within financial analysis is some sort of prediction on what the company's future sales, profits, and profit margins will be. Again, we don't have to be 100% accurate, but the idea here is to understand what we are getting into, and this is done by looking into the past data and by comparing the performance with competitors. Another very useful thing to do here is to read up on all publicly listed correspondence like the annual report, the earnings call transcript, etc. And if there are still some lingering questions, then gulp up a vial of Felix Felicis and write to the company's investor relations department or the management, asking them to spell out their revenue, volume, and margin projections over the next 3 to 5 years. So essentially, you'll have to do some fundamental analysis, and if you're very new to this, then do explore Fisdom Academy, which has a growing number of free and paid courses, including this one on fundamental analysis, where you'll understand the different techniques, you learn about sector-specific industry models, qualitative and quantitative analysis, and a lot more. This course is suited for beginners, and if you're keen, then type in the code SKN20 in the checkout page for a 20% discount on the course fees. As always, the course link is available in the video's description. A cardinal rule of turnaround investing is to not invest in a troubled company until the management team has been changed. Fact is, the existing management rarely fixes the problems that were initially created under their watch, and unless this management owns a significant amount of shares or has proved their competence earlier, I'll suggest an investor should always wait for the new management to step in. A good example of this is CG Power and Industrial Solutions, which is now part of the Murugappa Group and has completed a financial turnaround under their new management. That's the operative word, a new management that has worked super hard to clear debts of over 2,000 crores and generate profits for the company. In an ideal world, the perfect new management is someone who has the experience of turning around companies, and I should also mention that it takes at least an year, even 18 months, for the new managers to have a positive impact on the ailing company. In the meantime, it's important for investors to track their progress on a quarterly basis, including the executive compensation package, which should in its majority be linked to the company's business and the share price performance. Another positive hint is if the management itself is buying shares in the company with their own money, which is like a stamp of approval that the management and the shareholders' interests are completely aligned. The fourth task when examining turnarounds is to perform basic technical analysis to see if the share price is forming a base, a bottom or not. Now, many investors, including myself, suffer from a fear of charts, often assuming that technical analysis is too subjective and that it has no predictive value. But as I further my own education, I've come to realize that charting does have its utility and it does help in determining if a stock is being accumulated by others, especially institutional investors, which is very useful in case of turnarounds. And it also helps us gauge the psychology and emotions behind a stock price action. In other words, successful turnaround stocks have repeatable and identical patterns, and an understanding of that can be a serious advantage in turnaround investing. Now, I won't go too much into this because I myself don't understand this much, but from the research I did, there are three basic charts that show a lot of promise. Firstly, there's the double bottom, which indicates the support levels of a stock. Then there's the reverse head and shoulders that signals when a downward trend is nearing its end. And then, of course, we have the breakout scenario where the price of a stock moves to the right of a trend line. My point is the price and trading volumes of a turnaround stock offer important signals that can be very helpful for investors. I should also mention that buying turnaround stocks in a downtrend, which is also called catching a falling knife, is a ridiculously bad idea, and one should move only after a bottom has been formed and there is a significant break in the technical price support levels, which is backed by some good news about the company. And finally, like every strategy, it's very important to look at turnarounds as a portfolio of stocks, because this is certainly one area where things are quite unpredictable. Some companies do really well, others are just surviving, while many more companies aren't able to get their affairs in order and generally go bankrupt. In that context, turnaround investing is a lot like venture capital investing, and for all practical purposes, you're actually betting on the management team to generate a significant return by smartly redeploying the assets. So as a piece of advice, always keep a large enough universe of companies to pick from and choose those companies that can potentially offer you the best ROI. Never get attached to an investment just because you've committed hours of research or maybe you have some sort of positive bias towards it. Have the courage to cut your losers, and having a stop loss is very handy in turnaround situations. And much like any portfolio out of 12-15 stocks, one can expect the bulk of the profits to come from 2 stocks, 3 if you are lucky. Now, purely for this video, I've compiled from different sources a list of stocks that the authors say is poised for a turnaround. Of course, some of them might have already started that journey, but the essence of this list is to give you a starting point from where you can put in some quality mental hours to analyze, research, and understand each of these companies. So we have establishments like Usha Martin, which made this mistake of getting into steel manufacturing, got caught up in the steel cycle, sold that business, and are now doing pretty well. Thomas Cook India, very understandable as the company is recovering from the COVID shock. Suzlon has become leaner and meaner with net debt levels dropping from 11,000 crores to around 1,000 crores. Star Health, the health insurance company, has turned a profit after 2 tough COVID years and has attracted a lot of interest from foreign institutional investors. There is some news of Zuari Agrochemicals selling their stake in Mangalore Chemicals in a bid to refocus on their core business. Zomato has turned in a profitable quarter. The PSU banks are doing a lot better now. There is some talk of Bata India getting into a strategic tie-up with Adidas, etc. So this is just a selective list, and I'm sure there are many more companies preparing themselves for a reversal in fortune. But to recap what we need from these companies, firstly, there should be an improvement in sales, profits, and profit margins over the last 3 quarters as compared to the previous year. A reduction in debt with rising interest coverage ratio is always welcome. They should have a decent cash position, a reduction in SGA expenses, a new management, and preferably one that has done turnarounds in the past. The managers should also be shareholders in the company, and ideally they should be buying more shares. The charting patterns should be indicating a bottom and a breakout. And finally, one should be implementing this as a turnaround portfolio using the strategies and techniques that I've already explained in many of my previous videos. Understandably, finding a company that has all these qualities is next to impossible, but with a clear understanding of these principles and systematic research and analysis, anyone can find a nice set of turnaround companies which has the potential to deliver superior returns in the stock market. Do give this approach a shot. Do like this video, share it with your friends, and I'll see you 3 days from now. Until then.